A lot of different questions asked there. So, if we just stick to models, right? So, like, one of the things for Rad Diversified is we chose to be a very diversified portfolio. And so we have our residential real estate, and then I try to create, inverse correlations based on what I think like the economic movements of the market are going to be. And what I mean is, like, we started investing in farmland in 2020 because I saw what was happening with the pandemic. I thought there was going to be supply chain issues. And so I tried to create this diversified balance between our residential and our farms, and it's worked out well for us. Even within our residential, we have diversification between workforce housing and luxury housing. And so there's a unique balance. And so that's a diversified portfolio.
Hi, everybody. Jose Luis Morales here. Welcome back to another episode of the Morales Group Show. Today we have Dutch Mendenhall. I hope that I pronounced it correctly.
Nailed it.
Right. So today he is going to be explaining us what is a REIT, what is a real estate investment trust. I'll be completely transparent. I don't know very much about a REIT, so some of my questions may be elementary. But if there's one person to explain to us what a REIT is, it's actually Dutch. Welcome to the show, Dutch. How are you?
I'm really good, man. I'm really good. If you go back to 2017, I couldn't have explained to you what a REIT was either. So, fast forward to 2023, I, feel like I'm one of the loudest voices or strongest voices, right, when it comes to what REITs are, in America. But it's fascinating, when you're a real estate flipper or real estate acquirer as an individual, right, you're not thinking of the other games that are played in the world. And there's a lot of levels to the games in REIT. Obviously, when it comes to real estate, it's the highest level, I believe, that the game can be played.
I love it. So for our viewers that don't know who Dutch Mendenhall is, who is Dutch and how did you get involved in this wonderful world of real estate investing? And then we'll go into like what a REIT is.
Who is Dutch? When I'm by myself in a deprivation tank or meditative state, and I get I'm just teasing, bro. I'm a dad, man. I'm a husband. I'm a dad. I am a leader, right? When it comes to our team and our employees and our people. I am a philanthropist. I brutalize that word all the time. And I give a lot to veterans organizations, a lot to children's organizations. Who am I? I'm a person who cares deeply, but I'm also a person who's very much a bottom line, direct, kind of hard hitting person. And when it comes to real estate or it comes to finance and money, I'm working towards playing the biggest games in the world. And so that's a little bit about who I am. Rad Diversified and our Rad Inner Circles, we've built about a $200 million portfolio. And I would say, I flipped houses. I did the same thing where I started from scratch. Like I grew up in poverty. And when I finally had some money, I just tried to figure it out. Try to figure out what was real estate. It wasn't even about real estate in the beginning. I was just trying to figure out money. And I think a couple times over the years, I tried to get away from real estate. And it just pulled me back in like it was my calling. And so I went from flipping houses, and I started consulting real estate gurus and real estate thought leaders and real estate companies, and real estate investment companies. And so for a decade, I was behind the scenes and really figuring out this game at a level that most people can't imagine. And then there became a time where two or three of my clients said, Dutch, if you're so good at this, how come you don't run your own fund? How come you don't run your own real estate, education company? How come you don't do this? And I was at a point in my life where I said, all right, let's do it. My business partner, Amy, was also at a point in her life and we said, let's do it. And so that was 2015. And, we started our first private equity fund that year. I started a second one that year, a third one in 2016. And then we started the REIT in 2019. And I think in 2019, we were up to about 5 million in personal assets and about 30 million in collaborative assets with our investors. And now, being over 200 million assets just 3 years later, you can tell the pace and speed at which, we've been able to accelerate the real estate for our investors. And I say it's their money and their investments. And so really, I say it's our investors have built a $200 million portfolio in the last 3 years. And I think I always feel amazing about that. So hopefully that's enough about me.
Oh, yeah. I love it. And it's also a perfect segue. Like, so for the viewers that don't know what a REIT is, what is a REIT and why did you decide to go the REIT option versus maybe like a syndication option, or what's the main difference even between those two?
Yeah, I mean, I think it's the one problem I have with the syndication model, right, is it's really built for accredited investors, right? And we have a lot of accredited investors who invest with us, but at the same time, I'm very much about equal playing fields in the world, right? I'm very much about our Constitution. I mean, I love this country, and so the ability for each individual to pursue wealth, to pursue happiness, to pursue equality in our country is important to me. So when it comes to a lot of vehicles that are out there, they're built for the accredited. And so when it came to deciding to do a REIT versus staying purely what's called a Reg D or purely private equity, for me, it really came down to the ability for people, the
Everybody.
normal person, to be able to invest, right? And a lot of our investors are people that are in this like weird sandwich, and the sandwich is they're not so wealthy and they're not set up for retirement the way they want to be, but they're also not so poor that they're just trying to survive and live, right? And so they're in this weird sandwich, and then they don't get access to what the super wealthy or the super rich is. But reality is, being accredited these days isn't even about being super wealthy or super rich. Being a millionaire is not what it was when you and I were growing up 10, 20 years ago. It's not the same thing anymore. So I went the REIT model, one, because I feel like it's the best tax vehicle when it comes to real estate. I think number two is I wanted it to be open. And you can be a REIT vehicle, I guess is the way to put it. You can be a REIT vehicle that is for accredited only. For us, we're actually a public REIT, which means we're an actual security that the Securities and Exchange Commission, monitors, right? And so they decide whether companies like ours are qualified, right, to accept securities or not qualified to accept securities. And so I think another reason I went with the vehicle that we have as a non-traded REIT is because I wanted to establish our credibility above anything else that is out there. I think every person in the world says, my mom, my pop, my cousin, my brother who wanted to get into real estate or who invested, or that guy we knew or somebody we knew who had successful and is supposedly rich, right? When it comes to real estate, and every single one of those people have thought about, do I invest with that person, not invest with that person, right? With us, we have audits, right? With us, we have third-party appraisals of assets. With us, there's a set of rules that we have to adhere to, and at the same time, we're at a scale that any one problem, is never going to affect the totality of the whole portfolio, right? And so for me, I think that credibility, that taxation, that openness to all investors is a lot of the reasons I did it. We're also chose, as a public security, we chose not to be on the exchanges, right? And that meant in the beginning, we were gonna grow a little bit slower as a company. But what it meant to me is stability for our investors, that what happens in, whether it's the debt ceiling thing that we just went through, right, or it's the pandemic, or it's something Bezos or Musk says or someone else says, it's not going to affect our stock price, right? The entire economy can affect, the values of real estate are going up or down, and that can affect, net asset value and those kind of things. But we don't fluctuate with the wind, is the way I'd put it.
I love it. Now, since everybody can invest, is there like a minimum investment that you have to make into a REIT, or how does that portion work? I know that when I've invested into syndications before, there's like a 50 or even like $100,000 investment. Do those exist in REITs?
They do, but we're $1,000 minimum investment. And so, like what I said is, like, I wanted equality, for people, and people to have the ability to invest. And the reason it has to be 1,000 is because with the way the industry works in those type of things, if it's not 1,000, then the basic fees for even processing transactions become it would make year one, unprofitable no matter what return we get. So for me, we established $1,000 minimum, and I think that's worked really well for our investors. And our investors who've invested 1,000 have, been able to turn a great, as much as a 30% profit, year one. So I have to do since we're getting directly about the REIT, I have to do some disclosures. Past performance isn't indicative of future performance, right? So any numbers I've shared on the podcast, right, with you, Jose, I have to put those things out there. We have a lot of rules with what we're allowed to say and not say because we are a public company.
I love it. No, I think it's good too. I'm more curious because I've done syndications. I've owned my own rental properties. And REIT is a term that I've heard multiple times. I just don't know very much about it. I don't even know, like, do REITs pay cash flow? Like, meaning, like, do investors get dividends on the investments that they make, or does that just get calculated into the REIT price, or how does that entire aspect of it work?
Yeah, bro, that's a phenomenal question. So there are different types of REITs that are out there, and so depending on what the REIT focus is, will determine on how their dividends or their distributions or how they work as a company, right? So we're an equity based REIT. And I'll give an example of what we are, and I'll give you a comparison of what another version is. So as an
I love it.
equity based REIT, my job is to create what they call net asset value, which is the total value of our assets, right? Obviously minus liabilities. And so as net asset value increases, our stock price for our investors increase. It's not about how it's traded on an exchange and not about the market up or down. It's purely asset based, right? Valuation of our stock price. And so for us, we're not as worried about cash flow, or we're not as worried about, now we have cash flow, right? Don't get me wrong, right? We're a company that, pays our bills and covers our debts, and we stay very responsible, right? From a safety standpoint. And that's very important to me for protecting our investors, right? A lot of the decisions we make daily is how do we protect the investors. At the same time, on the opposite end, it's how do we maximize their return. And so, as an equity-based REIT, our whole goal is to increase equity. And then when our third-party evaluations evaluate our assets, how are they going to evaluate them, and how does that help the stock price? Now, on the opposite end of the spectrum, right? There's REITs that are cash flow based REITs, and so cash flow based REITs, pay out 90% of all REITs have to pay out 90% of their net profits, right, to their investors as dividends. And so for a cash flow based REIT, if they're making 6 to 8% return on the cash flow from their assets, and then when they subtract out their fees and stuff, then that cash flow is paid out as directly to their investors. Now, I think that's a great safe model, right, for people that are looking for stabilized return on investment and looking for a certain type of model. Now, our equity based model, one of the complaints about like a non-traded public REIT like ours is they say availability to capital, right? People want to have access to their money, and if it's not on an exchange, I can't buy and sell the stock every single day. So what we did is we hybrided our model, and we did what's called a distribution model. So we give our investors the opportunity to be able to for us to buy back stock every year. And so in 2020, we did 5%. In 2021, we did 5%. In 2022, we actually did 8%, and then another 5% in 2022. So investors had access to sell 13% of their stock. But on top of that, they can fully redeem their stock twice a year with us. And so if they wanted to sell 100% of their stock twice a year, they have events so they could do that. So we tried to create 4 events in 2022. So every quarter we were working to give our investors an ability to get access to capital. And so for us, a dividend is what I call a forced taxable event, where a distribution is an elective taxable event. And so that's kind of how we choose our model, right? Also, I like getting the returns we've gotten for our investors, and so our stock price has increased by higher than an average of 30% per year, right, since 2019. And so for me, I like our equity based model. I also think, though, that all investors need to have balance and be diversified. And so for me, if someone invests in our REIT, I think they should also invest in a cash flow based REIT, because I think that would be healthy for them to balance out their portfolio. And obviously, you shouldn't put 100% of your money in crypto or 100% of your money in real estate. I'm not a financial advisor, everybody. I'm not giving personal financial advice. I'm just giving, like, as a thought leader who's been investing my money for a long time and studied it since as long as I can remember. I have to caveat that I started studying as long as I can remember. I started in my 20s, right? At 22, I didn't really know what a credit card was or what a credit score was, right? So, because I didn't grow up with money, but I'm 43, so now on 20 years, I've been studying it and diving deep into it on an extremely high level. So if you're 23 and you don't know what money is, well, there's definitely hope for you.
I started at 23 too. Before 23, I was a little bit of a knucklehead, after 23, I started learning everything, and it's really interesting how much you can grow in a 20-year period or even in a 10-year period. So I think it's perfect timing for a lot of people. So this is kind of what I understood of it, and this is kind of the way I was thinking about it. And maybe I think this will help our viewers understand the differences in REIT. Like when starting a REIT, what are some of the different decisions that you have to make? And what are the pros and cons of each decision? So I think you went over a couple. You said, okay, you can either be an equity-based REIT, or you can be a cash flow, or you can be a hybrid. Then I think there was
And
a
there's a lot of other
public.
models.
There's a lot of other forms.
Models.
Do, do
Yeah,
you
there's a lot
do
of
you mind
models.
kind of like if we go over like when starting a REIT, like what are some of the different models, just so our viewers have like a broad understanding of what is available to them when selecting a REIT, and then we can touch maybe on some of the pros and cons of each one. So, what are some of the different models? So there's equity-based cash flow. There's a hybrid. What are some of the different models available for people as it
Yeah,
relates
I
to
mean,
REITs?
so there's a lot of different questions asked there. So, if we just stick to models, right? So like one of the things for Rad Diversified is we chose to be a very diversified portfolio. And so we have our residential real estate, and then I try to create, inverse correlations based on what I think like the economic movements of the market are going to be. And what I
Mhm.
mean is like we started investing in farmland in 2020 because I saw what was happening with the pandemic. I thought there was going to be supply chain issues. And so I tried to create this diversified balance between our residential and our farms, and it's worked out well for us. Even within our residential, we have diversification between workforce housing and luxury housing, and so there's a unique balance. And so that's a diversified portfolio. Now, a friend of mine, Scott Myers, who's self storage,
Yeah.
thought leader in the world, right? Scott and I've been friends for a very long time, and if he went and started a REIT, he would be self storage focused. And so he would be probably singular asset class focused, and it would be based, that REIT would be based on, specific type of returns, and a specific type of cash flow model, right? Then there might be a REIT that's focused on development. And so that's a REIT where you might put your money in today, and it might be 5-10 years before you get your money out, because for large construction projects, it might take that long, right? I think there's a thought leader in our space that's building like 1,600 units, like on the beach, right? And so that would be a different type of model, because there wouldn't be any access to capital for a long time. And so I think for each investor, they kind of got to look at what is their plan and what is their model. The REIT designation itself is a IRS tax designation, right? And so 90% of all your investments, I think, have to be into real estate if you're going to be a REIT.
Mhm.
I feel like no more than, and I want to say 10 investors can't own more than like 50% of it. And granted, everybody, I'm not a tax professional, I'm not a CPA or an accountant. So as a CEO, we have lawyers, we have accountants that know these things inside and out for our company. But I'll give you the best I can with it. And you have to, the 100% taxation is if you can't be a flipper in a REIT, and so you can't buy something, flip it the next day, and not be taxed on that. But if you put 30% into capital improvement into it, into rehabbing it, into fixing it, and then you sell it, then there's no taxation on it. And I think that's one of the cool parts about a REIT is I can buy and sell properties. There's no 1031 exchanges. There's no capital gains within the individual REIT itself, which is a pretty cool tax shelter. So I'm not giving financial advice to anybody or tax advice, but I'm from my knowledge and how we run our REIT, that's my understanding.
But I think one of the pros and cons is like if I wanted to buy and sell a property and not 1031 exchange it, I have to pay capital gains taxes, which
Yeah.
means a chunk of that profit gets taken out. And then if I reinvest the profit, then then there's that chunk that was taken out. So it doesn't compound as much as comparison to a REIT, where as long as you do 30% in improvements or whatever that was, the money can continue growing.
After 2 years, we can sell an asset and we don't have to do the 30% in improvements.
Okay.
So it's not even. It's just if you're going to flip quicker, you have to do the 30% in
30% in
improvements.
improvement.
But after 2 years, you can sell a property and not have that challenge, right?
Which
I think some of the other things I think that are important for investors is when you look at what a REIT is, there's different types of REITs. Like we're a public REIT. So there are REITs that are private REITs. And so a private REIT gets to basically do whatever they want. And there's very little scrutiny into their finances. There's very little, like the Madoff Netflix series, he was a private company and he was a private entity. And I think, I think that series nails a lot of good stuff when it came to what to look at. But I think they missed putting out like, here is A and B, investment safety, non-investment safety, right? Now, all investments have risk. Investing with my company has risk. And if I don't say that, then you're an asshole and you shouldn't be leading an investment company, right? And so like my company has risk and we invest, and I feel like I do everything in my power to keep my investors safe and to protect them, but at the same time, it has risk, right? Yeah. So anything that seems risk-free is something you should run away from. Mm-hmm. Absolutely. No matter what the investment is in the world, unless it's a government-backed, 1%, bond or whatever the yield is on those things today, right? Then that's probably more safety and protection in that, right? But even with like savings accounts, if it goes past the FDIC insured amount, then it's really not safe and protected at that point when we saw Lehman Brothers and other big banks go out of business in 2008, right? So everything has risk, everything you do. And so your job as an investor is to figure out what's your calculated REIT. So we're a public company. So public REITs undergo a lot of scrutiny, and public REITs on the stock exchange go through a scrutiny. Public REITs like us that are non-traded go through scrutiny. We go through third-party auditing. We have to adhere, whether it's our advertising or whether it's, GAAP accounting or it's, however we handle our books and those kind of things. It's all monitored and paid attention to, right? And I'm not saying that there's never been a public company that did things wrong. Obviously, that's existed too. But in the Madoff series, what they have to get, there's just so much a difference between private and public. For us, we fall under what's called a Regulation A security, which is a Jobs Act security. And so for us, we have specific rules we adhere to, whereas other REITs, there's personal money that people turn into what's called an UPREIT. And when people are using their own money and they're using the tax vehicles of a REIT, right? And so I think for an investor, I would say you want to look at companies that are real, intangible, and you can see their assets. I think you want to look at companies that have cash and have cash flow. I think you want to look at companies that are public versus private. Sorry, private equity, right, in America, but I think that is the trap that money could be destroyed and lost in. That's my own personal opinion. I know that I ran 3 private equity funds at one point in time, and I look at what we had to adhere to back then, which I would say is nothing, to what we have to adhere to today to be the company we are is night and day. And so the ability, for what we have to hold to the standard it's just a completely different level as public versus private. And then there's
basically there's just a lot more scrutiny, which means there's a lot more eyes on the public one versus the private one, which means that you can it sounds safer by being public than private. Would that be?
No? That'd be my opinion, right? That'd be my opinion. And so like me, a lot of people who run companies don't love it when a customer complains, right? For me, I love it when a customer complains because they're telling me how to fix or adjust or adapt or change my business, right? And I'm not just talking about like the one-off, crazy. I'm talking about, anything that becomes, an active conversation you have to pay attention to, right? And so like same thing when the SEC gives, every year we have to submit, paperwork, we have to submit documents to the SEC, and the SEC comes back with comments. Like one of the more recent, comments that the SEC came back with us is we had a video out there and it said, it was a testimonial for our inner circle, right? Which isn't our REIT, but it was saying, I've never lost money with Rad Diversified, right? And that's not something that they like. It's true, but they don't like that, right? Mm. And so for us, we took that video down and those kind of things. But I get why, and the reason why is because the SEC doesn't want anyone out there thinking they could make an investment and not lose money, right? Their job is to protect consumers, to protect investors, to keep businesses to hold accountable and to align. That is not something that private companies have to do. There's rules obviously with the private company, and if you're not handling your books the correct way, right? There's definitely that's definitely a crime. But there is a difference between the monitoring of a public versus monitoring of a private, for sure.
So is the SEC involved also in private or only in public REIT?
I don't. I mean, like, so there are rules that a private REIT would have to follow. Like a private REIT can't publicly advertise, right? A private REIT can't bring in, an endless amount of non-accredited investors, right? There's definitely some rules, and if they cross some of those lines and rules, or if they were doing things they're not supposed to do, I am sure the SEC would get involved and work
Yeah.
on protecting citizens, right?
Perfect.
But they don't have like a detailed reporting they have to do on an annual basis or a semi-annual basis. And so for them, if as long as nobody's complaining, they can operate, pretty away from government eyes.
How often is that report again?
For us, so we do an annual audit, and then we have to do what's like a semi-annual check-in. And what a semi-annual check-in means, our auditors are going back and taking a look at our rules, our procedures, and a basic look at our books to say we're sticking to the operational right efficiency as a company that we stuck to when we did our audit, earlier in the year. But so we do a full audit every single year, and then biannually
December.
we do a deep dive check-in. And so we have to file to the SEC what's called a 1SA in the middle of the year, which also has updated balance sheets and updated books. And like with our investors, our balance sheets are on, you go to edgar.com, which is the government's website for those kind of things. You go there and you can find our balance sheets, you can find our P&Ls, you can find the things that we do as a company. As a private equity company, outside of my internal employees, nobody ever saw my books, nobody ever saw how we did things, right? I believe we do things today the same way we did things back then, as far as transparency and being real, but we didn't have to report to anyone back then.
And now the reporting basically. Good. Now the other difference between REITs is traded versus non-traded, right?
Yeah.
And I believe that you said that some of the differences are that I think there's less volatility with the price of the shares.
I mean, if you're traded on the stock market, any stock can be volatile within the stock market, right? Anybody who's
Mhm.
tried to master the stock market, those who do, love their life, and those who don't, have a never ending, needle in their eye, right? And
Yeah.
and so it's one of those things where, I mean, it's not dissimilar from crypto. Those who mastered it loved it, and those who didn't wish they had never even heard of it, right? And so for us, a public REIT are some of the biggest REITs in the world, right? And there is a statement or a phrase in the bigger investment communities, like too big to fail, right? I don't agree with that statement, because I've seen big multi-billion-dollar conglomerates fail, and I think when small companies buy small companies, then buy medium companies, and medium companies buy medium companies, large buy large, eventually you get massive conglomerates. The problem with the massive conglomerates, there's no founder continued to be involved. And I say, when there's no founder continued to be involved, there's a different purpose with running the company. Like our company has impact, initiative. What's important to us is important to us, right? And when you sell off, and there's no original ownership, or there's not employee based ownership, right? Then there's very little. It's like, I love our country, but when you work for a company with no face, or no integrity at the top, then there's nobody saying, I love this company. I love the impact this company makes on the world. I want to grow and make the impact of this company make a difference on the world. And so, like, what happened back in '08 was, you had huge boards and you had huge companies, and every individual was looking to see how much money they could possibly make for themselves. And nobody was saying, how do I save and protect people? How do I pay attention to people? Right. And I can't sit here and say that my investment is the safest investment in the world, because I can't. Right. It's obviously, all investments have risk. All investments are risky. But what I can say is at our company, there's a founder part to it. But you see companies like, when Amazon, when Bezos was taking it, or Gates, or you look at Musk taking Tesla, right? You see when companies hit those billion-dollar statuses, and there's still a founder. When Steve Jobs, right? And there's still a founder involved. What happened? But right. But how many people know who the who's at the top of Apple right now? Right? How many people know who's running Amazon right now? Not nearly as many people who know who Bezos is, right?
Mhm.
And so there's a massive difference between that. So lots of times when companies start becoming publicly traded and they're on the Securities and Exchange Commission, there's a different way that they're operated and ran than when they're non-traded. So
now, as it relates to the public or the exchange, whether or not it was publicly traded, does that mean that I could cash out on a REIT? Like if it's,
so if you're on
I
a
guess,
publicly traded REIT, you could probably cash your stock out the same day you bought it. You could cash it out a week later. It's completely choice, right? With non-traded REITs like ours, each individual REIT is going to have a set of rules. So our set of rules is our investors can have access to redeem their stock twice a year, which means our company, I buy back their stock personally, not myself as an individual, but as CEO of Rad Diversified. Rad Diversified buys their stock back. Twice a year, we give sellable events. Then what we've done as a company is if we've created other what I call distribution events, which is this last year gave our investors 4 times for the year to be able to, sell back stock and be able to, take the gains if they chose or need to.
how does the tax aspect work as it relates to REITs? Like meaning like, let's say like, or not as it relates to REITs, let's just go like as it relates to like an equity based REIT where let's say you buy shares at 10 and you sell them at 20. Like if I'm buying a property at
In that
100.
in that instance, your original gosh, and I'm not a financial or tax advisor, but I believe in that instance, your original basis is $10, right? And so you're going to be taxed on the other $10, right, for your capital gain. And so you said you bought it at 10, sold it at 20, right? So you're taxed on that 10. Now, in our instance, there are other tax vehicles if you sell your stock. And I think that's one of the things that, like, I wish they taught children, right, this stuff. Maybe children, maybe junior high, maybe college. But my boys are 6 and 7, and my sons already understand tithing, right? They already understand saving. They already understand investing, right? They don't understand 100 words when it comes to money, but they understand 10, right? And every time they get money, they absolutely have to do those things, right? Our Sunday school teacher came to me last Sunday and said, "Your son's giving this money for tithe." It was just his birthday, so he got a little bit of money, and like that seems like a lot of money for a 7-year-old to be giving me. I think it was only like $25 or $30, but it seems like a lot of money for your son to be giving me. I said, well, he knows tithing is one of the first steps, right? When he gets the money. So, philanthropic work, if you're not a tither, then you need to be giving to charity and nonprofits, because what's the purpose of money if it's not to do good things in the world?
Mm-hmm. Okay. And then, like, what would you stay away from? Like, if you were investing in a REIT, like, what would be some red flags? Like, if you saw these flags, you'd be like, oh man, like, I don't know, almost like a Bernie Madoff type of thing. Like, what were some of those red flags that maybe like stay away from these types?
So my first thing I say, read the book Richest Man in Babylon, right? Greatest book ever, I think, when it comes to basics of money and finance, right? Smartest, wealthiest man I knew when I was 25 years old. I asked him what is his best book on money ever, and he told me Richest Man in Babylon, and I figured that was good, to learn from the smartest, richest man that I knew, right? Mm-hmm. And I read it, and it's a short, quick book, and one of the first things it says, invest with somebody with a track record and history of success, but also invest with someone who has a track record and history of success investing in, right, and what you're investing in. So don't take someone who's been, a dog groomer, right, and invest in them for the buying and selling of horses, right? And I know it's kind of a crazy example. I mean, we do invest in farms and run farms, right? So for us, I don't want to go and invest for someone who's got $100 million new construction REIT, and I go and look at the founding leaders of the company and say they've never built, never developed, they've never built new construction before in their lives, right? And so for us, like we bought our first farm before we even told investors, that we were really thinking about investing and doing farms, because I didn't need investors investing with me because of our farm experience. I needed them investing with us because of our real estate chops and residential real estate. Now you fast forward years later, I feel very comfortable telling people we're a farmland investor and we have a history and track record of investing in farmland. So one of the things is if you're looking at a REIT and they've never done that type of business before, then I would sit there and say, well, let's look at their founders or look at their significant stakeholders. And if there aren't people with a success track record investing in that vehicle, then don't do it, right? there's other things that are out there too, right? And like there's huge tech companies. If you're a tech company, you're not a real estate investment company. Just because you know how to raise money doesn't mean you're a real estate investment company, right? If you're a company that has access to $1 billion but you've not cut your teeth, like you and I cut our teeth flipping houses, right? We cut our teeth like knocking on a door, right? I remember, first time San Bernardino, right? California, palm sweaty, 100 degrees out, guys sitting on the porch, and I'm like scared to open the gate and go approach them. Some of the nicest guys I ever met in my life. But until I walked through that gate, I couldn't know that. And so like for me, if people come from $1 billion and they come from Wall Street, I don't think their decision making when it comes to the individuals is the same as guys like you and I. And so for me, there's that part of it. I think I take a look at when you can't understand what they're doing. I think that's also something for me personally that I would stay away from. Like you need to understand at least to a basic sense. Like for me, our real estate's simple. People need a place to sleep. People need food to eat. Until the end of times, people will need a place to sleep. People will need food to eat. Right. And there's some great vehicles out there. And so you need to spread your risk out. But when people start talking about, energy, and they start talking about cell towers, and they start talking about, different kinds of things, and they start talking about conglomerate technology, and then having the real estate behind that and stuff. And maybe some of that is good, but unless I understand and know it, I'm not going to just throw money at it. I might take high risk money in a high risk bucket and put money at something like that, but I'm not going to put in my savings, my retirement, my wealth in there. I think everybody should be investing into something that has a potential home run, right? But anything that has a potential home run is something that has also potential to be zero. And so that's
swing and miss, basically.
You swing, you miss, and you got to swing in order to hit, right? And so I never stop having a small bucket that is focused on home runs, right? But I'll tell you, in real estate over the years, some of my home runs haven't been stuff I ever thought was going to be a home run. Right. Some of the home runs I thought were going to happen in real estate were the biggest, longest, most painful headaches of my life. And so for me, and when it comes to real estate, I think just the next deal, just the next good deal, is important to me. Guaranteed returns, I think, is something people got to be super careful with. Anytime somebody, is just, unapproachable, when they're not communicating with you about what's happening and what's going on, I think those are things that are there. When you ask for your money back, or you ask for a portion of your capital and then they make excuses, definitely don't ever put more money in at that point. Anytime somebody's rushing you to put money into something, like you're in a shortened time frame or you need to invest by this point or this time, right? You got to stay away from it. And I say that when I tell my people we're having a stock price change, in February, I always hate that because, I that makes sometimes has investors, who feel like they could get an extra gain, feel rushed in that standpoint. And so even I hate that part of it. You have to just, people need to be able to make an intelligent decision on their own. And when it comes to investments, no one should ever sell you. No one should ever have to sell you. They should be able to provide you with information. And the moment you start feeling like you're sold, you should absolutely stay away. And private, for me is I don't like it. I don't like it at all. And the reason I don't like it is because there's not the scrutiny that there is on public. So those would be a few of my opinions.
Well, what I was going to ask you, Dutch, is how would, like, you mentioned something important, like to look at the track record of the individuals and look at the backgrounds of the officers and the people involved in the company. That way, if they're like going to be investing in land, that they have some sort of track record, or almost like looking at that. Like, how would I verify that? Like, do I go on edgar.com and is this how to verify it? Or like, how do I verify some of this information?
Yeah. I mean, if they're public, they absolutely should be on Edgar, right? And that is this, you should be able to do research and do due diligence. So a couple of things that I've come across that scared me for people. One was I was at this business gathering, and there was this speaker they were bringing up who supposedly had managed $1 billion in assets, right? And he was actually from Australia. And as I'm up there and I'm listening to him, I just, I said, if this guy's a billionaire, why is he saying this? Right? If this guy's managed $1 billion in assets, why does he have a low cost membership program for $10 a month? Right? If you're a billionaire, starting low cost membership programs don't seem to make sense to me. Right? And as I listened to some of the things that he was saying, I'm doing my research and I'm Googling him. Right? And that's a great place to start. And so when you Google somebody or a company, you're going to look at the totality of information, right? I think Walmart's one of the most sued companies in the entire planet, but I think no one in the world would say that Walmart is a scam, right? Walmart is what Walmart is, right? And, they're one of the, biggest buyers of products in the world, and they're one of the largest sellers of products in the world, right? And when you're one of the largest companies in the world, you're going to get sued a lot. So when you start looking at something, you got to look at the totality of information. For us, I think our track record online, if you go and research and dig at us, right? Are you going to find perfection? No. Are you going to find it's pretty damn good with tens of thousands of investors? I think it's as good as anything on the universe, right? There's stuff like BBB. There's stuff like Ripoff Report. There's things that are out there that you can do research on and you can look at. Companies that do true verifiable stuff and really look at companies to see legitimacy and real. But if they're on Edgar and they're showing up as an active qualified security, I think you're at least one step in the right direction. But you got to do your customer service track record, right? And if you look at a company that has here's a great example. So when I researched that guy in Australia, I couldn't find anything negative about him in the US. So I went to an Australian Google search engine. And then I found he had lost his licenses for being a financial advisor. And I found other stuff about him from a lack of legitimacy standpoint, but it took doing a little bit more due diligence. Another one that I did is I was looking at this company, and they were talking about their returns in the future. And they were talking about 30% returns on some quadplexes they were building like in August of 2022. And so I was looking at this in 2021. I was saying, in 2022, they can't know what the returns are going to be on this asset because they don't know what the appreciation level is going to be. They also don't know what the cost of materials, cost of labor, cost of lumber, all of those things change dramatically between 2021 and 2022. So making predictive values on assets in the futures is definitely a mistake.
It's not real. It's
sure.
basically it's not real.
So anytime anyone's saying here's what the future ROI of an investment is online, I think for me that's something I kind of tend to stay away from. We'll tell you what we've done. Here's what our history and track record is. I'll also say that the past does not indicate the future. Now make your decision. We're going to buy the next deal. We're going to buy the next asset. We're going to make the next investment. But the ability to say what an asset's going to make you in the future is a lie. Now, I can sit here and say to you that at one point in Philadelphia, we were buying houses for $5,000, $10,000, $20,000. And I had a firm belief that every property in Philly, any rehab house was going to hit 100K because that's the only thing that non-traditional lenders would lend on. And there were just other indicators. I said, we'll hit 100K. Now, I will flat out say that was a guess. And I didn't know that was going to take 18 months or 2 years or 3 years to happen. Did it happen? Yes. But when I was stating it, I made it very clear, hey, here's something I see that's a potential guess, right? I think interest rates are going to take another big raise here in 2023. In 2022, I didn't think they were going to continue to raise into 2023, right? And so, my predictions aren't by any means perfect, but I'm constantly reading, constantly adapting to the market, right? So those things are, anything future based is always has to be a guess, and anybody who says it's anything other than a guess is full of crap.
Yeah. And then if I'm looking on Edgar.com, like how would I what am I looking at?
They have a search engine. Yeah, so you can search names of individuals, you can search names of companies on there.
And then let's
people, you should get like one or two people from the SEC on a podcast. I don't even know if they would do it. We should get them on a podcast, right?
I would love to. And that's why I wanted to have you on here just because I'm all about providing like real estate education for people, and I'm all about helping people like just be more educated, because the more educated they are, the better decision-making process that they can make when either investing in a REIT, investing in a syndication, or doing their own flips. But this is opening my eyes to just different things that I wasn't aware of, and maybe even to investing in REITs to diversify a little bit more as well too. I think
if we do more podcasts, right, bro? Like to get to where I am, I had to do everything anybody listening had to do. So that, like you and I said, we both have knocked on doors, right? And I know that sounds rudimentary, but when you're doing, like when you cut your teeth in real estate and you've never knocked on a door, you haven't truly cut your teeth in real estate.
Yeah.
That'd be my opinion. I'm not saying that everybody in the world has to go knock on a door, but men like you and I understand that sweat equity. So whether, it's wholesaling or it's rehabbing or it's subject twos or it's short sales or it's every one of the tools and techniques you and I've heard about or we've done right during our careers, I've been through too. And so, if we ever get a ton of questions from people too that, we could answer on a podcast together, that'd be cool because, to get to where I am, it's a long journey. It's not going to happen overnight. Like I hate when somebody's selling something, they're like, you can be me. Right. And the answer I would usually say would be maybe. To get to where I am, there's some luck involved, right? There's some right timing involved, and then there's tireless and endless amount of effort and work when it comes to the brain to figure out every rule, every step, every new pedestal, every new vehicle, right? And each way you go in real estate, there's another phase to the game, right? Just like you having your real estate license, there's a difference between a wholesaler and a real estate agent. Absolutely. There's a difference between a real estate agent and a broker. There's a difference between a broker who's just a broker and a broker with a staff and a team of people. There's a difference between a singular broker with a singular office and a broker with multiple offices, right? There's a difference between an owner of franchises and a franchisee, right? And so each step of that game, if you're going to level up the pedestal, you have to make that decision because at some point in time, you might say, no, I have no need to level up. I'm great financially and I'm going to focus only on, family time, right? For me, my family is incredibly first for me. And so sometimes I don't know how we achieve the milestones we do. And then I still stay, I still feel like yesterday I brought my son Micah to the office all day because I was like, I haven't seen him in 2 days. And then like, I'm going to bring him with me. I'm going to spend the day with him. So I mean, it's all about choices.
Yeah, that's awesome, man. Good. I think we'll end it on that note. Is there anything else, any final words as it relates to REITs that you think would be helpful for people or that you think would help people either invest in a REIT, make better decisions as it relates to REITs, or any just final words?
I mean, I think what's really important for people as they look at REITs is each vehicle you invest into, you can't just look at the amount of money it's going to make. Like the money it's going to make is great. And that's awesome. That's the whole reason we invest is to make money. But what is the tax that comes with that money? And how does the tax balance, right? It doesn't matter how much money you make if you're at 100% taxation in the world, right? And so like there's a unique balance between being able to protect your returns as much it is as making returns. And so for REIT investors, I think you have a great tax vehicle from an investment standpoint where you can remain in control. And I think that's kind of a cool part. There's a lot of places where you invest your money and you can't keep control. You can't choose to withdraw. You can't choose to leave. There's a lot of things where you don't know exactly what's happening or what's going on. So I think transparency, I think being able to keep your money when you make it is important. So, I mean, all those are, I think a unique balance part of the conversation.
I love it. Cool. So I want to say thank you, Dutch, for being on the show. I look forward to doing different ones. One of the ones that you mentioned was opportunity zones. I know that you are doing some things there. I'd love to have you back on for that topic. For our viewers out there, we had Dutch Mendenhall, which believe I'm pronouncing it correctly. He explained to us what a REIT is, what to look for when you're investing in a REIT, what are red flags. And he is one of the founders of Rad Diversified as well, too. What is the best way for people to find you, Dutch, if they wanted to get in contact with you or your company? Is there like a social profiles, Instagram, company phone, YouTube channel as well, too? How can people get connected in your world?
Yeah, absolutely. So they're on social. We have the Rad companies. And so that's a way to come look at us. You can go to Dutch Mendenhall. As a way to check me out. My business partner, Amy's Amy Baughn, Baughn, right? I'm sure in the descriptions, you'll throw some links down there too. You can go to raddiversified.com and take a look at our REIT. You can go to RADIC and take a look at, our inner circle, our private club. They're all housed together and work together. So there's a lot of, if you take a look at us, you'll find us. And once you find us, right, you'll start seeing us everywhere you look. So it's kind of the way we work.
I love it. I love it. Good. And for our viewers out there, if you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode will be helpful for somebody make sure to hit that share button and send them a link. Thank you, guys. I appreciate your time. And thank you, Dutch, for being on the show again.